Did you know that pension plans are one of the government's largest liabilities? Let's look at how pension plans are presented in the government's financial statements. Thousands of workers contribute to these defined benefit pension plans that are intended to guarantee them an income during their retirement years. First, let's talk about pension assets and the two kinds of pension plans, funded and unfunded. A pension asset is money that the government sets aside for its retirees, and it comes from three places: contributions paid by current government workers through payroll deductions, contributions paid by the employer, in this case the federal government, and money earned from investing the contributions. In a funded pension plan, pension assets are set aside primarily to pay the retirement benefits. This is the type of plan current federal government workers most commonly contribute to. In an unfunded pension plan, the contributions are deposited in the government's bank account, which is used to pay for retirement benefits as well as many other things. With unfunded pension plans, the government closely monitors its cash flows to ensure retirees receive their retirement benefits. Now, let's talk about pension benefit obligations. These are the government's estimate at the present time of retirement benefit payments it will have to pay out in the future for its current workers and retirees. The pension benefit obligation is an estimate that involves many assumptions, including a worker's salary at the time of his or her retirement, life expectancy, inflation, and an interest rate used to estimate the value of future payments in today's dollars. Because there are many assumptions involved, estimating the pension benefit obligation is a complex exercise. For that reason, the Office of the Chief Actuary of Canada helps the government calculate this number. Let's look at how pension plans are presented in the government's financial statements, specifically in the Statement of Financial Position. Let's use the example of an entity with three different pension plans. Plan A is funded. It has assets of $120 and an obligation of $90, leaving a net asset of $30. Plan B is also funded. It has assets of $100 and an obligation of $110, leaving a net liability of $10. Plan C is unfunded. As we saw earlier, no assets are set aside for the specific purpose of paying out retirement benefits. Without assets, the unfunded plan is only left with an obligation, resulting in a net liability of $130. Here's how the net assets and liabilities for the three plans would be consolidated and presented. When a pension plan has more liabilities than assets, like in this example, the government may at some point need to use money from its bank account to pay out retirement benefits. This video explained the basics of defined benefit pension plans and how they are presented in the government's financial statements. If you want to know more about those pension plans, visit the Public Accounts of Canada.